Okay, Pankaj Murarka is with us, CEO and CIO at Renaissance Investment Managers. Pankaj, great to have you with us here. Thank you very much for your time. Individual names, Pankaj, I mean, you got to be in them. Otherwise, you just see them shooting up like rockets all around you. and so many of these, right? You just sometimes, and as someone was lamenting, everything that I don't have keeps going up. I think. How are you looking at things, Pankaj? You know, we had a nice up move and a bit of a pullback now. What's the view?
Morning, Prashant. Prashant, I think as far as markets are concerned, meaning our views, while primarily we still remain, the underlying trends still remain bullish. So we are very much in a bull market. But I think we think probably over the next couple of years, the gains from markets will be far more moderate than what we've seen in the last 3-4 years. The fact is that we are in the 6th year of bull market in the most expensive equity market in the world. And more importantly, we are now coming out of 6 quarters of earnings slowdown. The good thing is that probably earnings have troughed and probably starting this quarter could be a bit slow again because of that slowdown in sales in retail, which happened in the month of September, for the first 3 weeks of September. But I think markets will be looking forward to the next quarter, the third quarter earnings, where the spillover effect will be visible. So probably the good thing is we'll start seeing earnings acceleration now after 6 quarters of slowdown. Yet I think, while the index, what we've really seen, if you see over the last 4 quarters, is while index have held steady, but the broader market is where there's been a lot of action. And as you were rightly saying, there are a lot of stocks-specific action. But I think that's also partly a reflection of the pockets of market where we see a lot of fraud. So I think investors should be very careful in terms of what they're buying into and probably take a slightly more medium-term view.
Okay. But you are saying that earnings should pick up after several, dull quarters, and that's good to hear. Pankaj, good morning. Surabhi here. So the question really is that, what next? Because while the index has remained flat, individual stocks have done really well. I mean, even the large cap ones, for instance, auto. Now, on the whole consumer piece, do you think this is going to be a durable move that will last? And if yes, and what part of it? I mean, should one be in the auto space? Do you think that QSRs or other formats of discretionary consumption, or maybe even, regular staples, it'll be their time in the coming few months?
Morning, Surabhi. I've been saying this for a while, and now there is even more credible data points to suggest that. I think we are in for a very healthy consumption recovery in the economy over the next 4 to 6 quarters. We're coming out of a very sharp slowdown in consumption over the last 8 quarters. I think what the government has done in terms of the combination of monetary and fiscal stimulus that's been injected into the economy, on an aggregate basis, that adds up to about something like about $50-odd billion across tax cuts, 100 basis points of rate cuts from RBI, and now there's GST cuts. That's close to like 1% of GDP. So I think that's a very meaningful stimulus that's been injected into the economy. Consumption recovery, we've seen from past cycles, when they happen after such a prolonged slowdown, it takes a while. So while there'll be an initial burst or frenzy of the pent-up demand, because some of the discounts and lower prices will tempt marginal buyers. But more importantly, I think we'll see a more sustainable recovery in consumption over the next 4 to 6 quarters. And I certainly think so. One should be invested into consumers. We maintain an overweight stance on consumer stocks after almost a gap of almost 6 years, where I'm finding valuations are more reasonable in consumer stocks across both staples and discretionary. And we are looking for acceleration in earnings growth. And I think so is the case with autos as well, because you look at some of the data points in autos, the two-wheeler sales today are lower than what they were in 2019. Or passenger vehicle sales, especially small car sales today, are the same as they were in 2019. So it's been about 5 or 6 years of anemic volume growth that the sector is coming out of, which effectively means there is a lot of pent-up demand that exists in the system. And now with this stimulus, I think that will act as a very strong driver for growth in this sector. So I think consumption across both staples, discretionary and auto remains one of our preferred bets.
Okay. Hi, Pankaj. Good to see you. I wanted to ask you about the public sector banks. I was reading a Motilal Oswal note. They have pointed out the market cap has jumped nearly 5x in the last 5 years. Yet they're trading at reasonable valuations. The ROEs remain at around 18% odd, ROAs at around 1%. And now they're pointing out that public sector banks, they could outpace private sector growth, loan growth, for the first time in nearly 15 years. What's your view on the PSU banking names? The reason I ask you this is, just in the recent past, we have seen actually some bit of outperformance coming back into play after going through a period of underperformance. So what's your take?
Well, Nigel, PSU banks have come a long way in the last 7 years from where we had seen in 2018. These banks had huge losses because of bad loans and all of that. And government went through one round of consolidation in PSU banks. And from there, obviously, profitability has improved. But I would still say, if you look at on an operating basis, barring SBI, the operating metrics for most of the PSU banks are inferior or somewhat lower than private sector banks. So as far as quality in terms of ROA or capital efficiencies are concerned, private sector banks are much better than state-owned banks. Obviously, valuations, if you look across the board in case of state-owned banks, are much cheaper at points, depending on the bank you're looking at, somewhere between 0.6 to 0.9 time price to book. Most of these banks are trading on a 1 year forward basis below book value. So I think there's been some noise around government looking at one more round of consolidation among state-owned banks and government allowing higher voting rights for foreign shareholders and a higher increase in the voting cap of 20%. I think eventually, if the economy is to grow, and given the fact that state-owned banks are still almost like about 60% of loan market share, in the industry, these banks will need capital. Government in the past 6-7 years has given them enough capital, but government will have to, allow these banks to raise more capital in that sense and allow the restrictions, lift the cap on foreign holdings. So in valuations are reasonable, but I still think there's some more work that these banks need to do to improve their operating metrics. So I think there could be a valuation catch-up trade. And if at all the government goes ahead with, whenever we finally see the execution of IDBI divestment, because that's in the works for almost like 6 or 7 years, and probably there's another round of consolidation, I think that can help to improve valuations in state-owned banks.
Yeah, you've been a fan of PSU banks. And remember SBI was a top idea, right, Pankaj?
Yeah, so our preference still, Prashant, is for private sector banks. Within PSU banks, the one we own is State Bank of India, because we essentially like the franchise, because it's a very strong brand, very strong franchise. And in terms of most of operating metrics and capital efficiencies, be it ROA, ROE, or asset quality, State Bank actually is, almost at par with most of the leading private sector banks. So despite being a state-owned or government ownership, it's one of the best-in-class banks that exist in India.
Give us one or two ideas, Pankaj. Something looking interesting, away from the large cap, well-discussed names, where you think there is value.
Okay.
With full disclosure, please consult your advisor before investing. But yeah, go on.
Yeah, absolutely. All the disclosures apply. But I think we should not be hunting for value in this market. As I said, in the 6th year of a ferocious bull market, in the most expensive equity market in the world, obviously there's no value on the table. Stocks and markets are priced to perfection. But the good thing in India is, given India's secular and sustainable growth story, you can find a lot of growth stocks where you make money out of future growth, and buying them, I will not say at value, but at a reasonable price. So let me share a couple of ideas which I find interesting at this point of time. I'll give you a context. One, I am very positive on discretionary consumption coming back, as I said, because we're coming out of 8 quarters of very sharp slowdown in consumption. So just think about it. We have about 50 million people who invest in stock markets or trade in stock markets. And the organized pizza industry just has about 10 million customers. So Jubilant Foods is a company that we own in the space. They dominate 70% of the organized pizza market. I think that space can really expand significantly. I would like to believe that everyone who's trading or investing to stock markets can at least afford to have one pizza, a quarter or something like that. And if that be the case, that the TAM for that space can expand very significantly. So that's one we like on the discretionary consumption side. Apart from that, we like this the whole internet space I've been talking about for a while, because I think the growth visibility there sustainability of growth, high growth for a long term looks, very much possible in those sectors. So we like the food delivery sector. We own companies like Swiggy and Paytm there, and I think these companies can sustain, growth which is north of 20% for the next 5-7 years. So even while the starting point of buying is not so attractive, but I think the next growth over the next 4 or 5 years will compensate for all of that, and one can still make healthy returns from these names. As I said, all disclosure applies because we have ownership in all of those names I spoke about.
It's interesting you mentioned the pizza company and you mentioned Swiggy as well. Actually, I don't know if you think about it, before Swiggy and food delivery became such a phenomenon, right? Maybe that was the inflection point for, in a negative way, for Jubilant, right? Because now you could get Chinese, you could get Indian, you could get whatever you want delivered to your doorstep. Before that, it was Jubilant with their, delivery, and if you don't get the pizza in time, and you get the pizza free, and used to do very well.
Yeah, that's true. But over the last 4 quarters, if you see Jubilant, they've been making a lot of pivots in their business so as to enhance the TAM. They've introduced, I don't know if you are a consumer, but if you're not, you should try their what they call the square pizza that they've launched, which is a much bigger pizza, and they've added more value to the meals and had multiple other offerings, kind of a thing. So which is really leading to very strong growth that we've seen in the last 3 quarters. And this is happening in an environment where consumption spending has been slow. So when consumption picks up, I think they should be a beneficiary of all the investments that they've made in the business over the last 4 quarters.
And valuations are okay here?
Valuations are rich across the board, Prashant. If you want to buy a high growth, high quality franchise, there is nothing that is available cheap in this market. So one should reconcile to the fact that we'll end up buying some of these stocks probably expensive, but the future growth will compensate for that.
Yeah, okay. Buy, pay up for growth. That's been the mantra here. Thanks very much, Pankaj. Really appreciate your time and good chatting with you. And of course, all disclosures, once again, as you said, Swiggy, I think there was Jubilant and there was Paytm in terms of single stocks that we spoke about.